This episode of Good Investing Talks is supported by Interactive Brokers. If you're ever looking for a broker, Interactive Brokers is the place to go. I personally use their service because I think they have a great selection of stocks and markets you can access. They have super fair prices and a great tracking system to track your performance. If you want to try out the offer of Interactive Brokers and support my channel, please click on the link below. There you will be directed to Interactive Brokers and can get an idea what they offer for you. I really like their tool and it's a high recommendation by me. And now enjoy the video. Hello audience, it's great to have you back. Today I'm having Alex Kopel of Rowan Street on. And I want to start with my first question. Alex, frustration has led you to found Rowan Street. Where did this frustration come from?
So the frustration basically came out of this feeling that both me and my co-founder, Joe Maas, who I've known for about 15 years now, we actually met back while we were studying for our CFA exams back in the day. So we both ran into this frustration that we could not manage money the way we would do it for ourselves, for our clients. So we both came from, I worked for a number of big Wall Street banks, and so did my co-founder, and that was our frustration. And here's the truth that we found is all the effort and time and energy on Wall Street is currently spent on asset gathering. And because of that, the effort is focused on basically short-term relative performance and what I would call nurturing clients' emotional well-being while creating this illusion of safety that's not even there. And that almost always comes at a cost of reducing clients' long-term investment returns, and sometimes pretty drastically so. What we all know that in order to perform better than average, you have to pretty much stand apart from the crowd and do things very differently from what everybody else is doing. However, that behavior invites periods of underperformance from time to time, and that underperformance tends to be pretty disastrous if you're trying to retain client assets. So what the average money manager does in the industry is they try to engineer a portfolio in order to retain client assets, and basically mediocrity is the result. So that was our frustration, and that's why back in 2015 we tried to do things differently and set up Rowan Street from day one with a structure and the compensation system that is geared towards or allows us to focus on almost exclusively on the long-term compounding of client assets and not asset gathering, which in turn allowed us to focus on basically thinking and acting like business owners and not salespeople.
So how do your structures look like you decided to build for Rowan Street to achieve this goal of a great performance?
So we started off really slow. In the beginning, in 2015, we just started with our personal assets, our own assets, and we took in some very close friends and family, and majority of the fund was actually not invested while we kind of developed our and executed our investment strategy and developed our internal processes, and we didn't start taking outside capital until about 2017 when we were ready for it. But we set it up from day one in terms of compensation, as we don't charge any management fees at all. So for us, it's not about growing or gathering assets. For all our compensation comes from performance. So it's as simple as if our clients make money, we make money. If they don't, we make nothing. So and from that setup, everything becomes completely different. Your focus is different. The way you spend your time is different, and the kind of clients that you take into your fund are completely different from the rest of the industry.
Why did you go for the zero management fees?
Zero management fees was basically a way for us, just like I said, we wanted to get away from the focus on how much assets we have and trying to constantly grow our assets and bring new clients, because when you're charging a fixed percent or percent and half or whatever it is, basically you make money whether if your performance is good. If your performance is not good, you still make money. You make money in positive years and in down years, and as long as you have assets in your portfolio. However, if those fixed management fees are at zero and all you're charging is performance fee, and then your focus turns on to compounding of clients' assets over the long run. And we obviously have a high watermark. So if we lose clients' money, then we have to make the capital whole again before we earn another dollar. So not only it focuses our mind on long-term compounding, but also focuses our mind on protecting clients' assets from permanent impairment of that capital, which fixed performance fees don't do.
So with this system, you have to compete a lot and be competitive and focus on great returns. But the reward in terms of your compensation is quite far out sometimes. If you think about the first 2 years you had, where you had just like only your money managed and where you're from friends, and maybe if you have 1-2 lumpy years or 3 lumpy years, it can get quite challenging with the compensation. You also need to cover your cost of living. How do you manage this?
So absolutely, that's actually an interesting question, because it was very difficult actually in the beginning, and we were advised against it by numerous people, because that's just not the industry practices, and that's not how people do things. And we had our own, obviously, capital and our own savings to begin with, to start with this. But it makes it, I think, in the first few years, we weren't making any money at all. First of all, because we had very, low, only our capital and some of our friends and family, and also the returns we were only 25% invested, because we were very slow and deliberate in investing our money, and we weren't making much money, and that creates kind of a hurdle for majority of doing that, because if you're not getting paid and you cannot be paid for several years, that kind of roots out a lot of your competitors that are trying to do the same thing. Also, it instilled sort of a lot of discipline in terms of how we manage our expenses of the fund. We probably have one of the lowest expenses in the industry. We didn't start off with nice fancy offices and a team of analysts and Bloomberg terminals or anything like that. We try to, since we weren't getting paid in the beginning, we tried to keep our expenses as low as possible. Work from home, didn't get any fancy subscriptions. We went to kind of the original. Our research was done going through original materials that's published out there for free. We didn't have Bloomberg terminals, and we had sort of different contracts with people we outsourced with, but at very, very low cost in the early years. So it was a very lean operation, but now that we've been doing it for 6 years, it's very helpful, because we're still running that way, and we're much bigger now, and we are making money, but the mindset is still the same as when we founded it.
Maybe let me add another question. I'm not sure if I can get it that concrete and it works. How you're creating stability with this system, especially in the first 2 or 3 years, because there was always the risk that you didn't have success, and with this you don't have any income to cover your costs, even if they are the lowest as they are, but you need food and water and stuff and housing and whatever.
Sure. So again, when we started off, we both did have savings to live on. So for, it was enough to get us through first couple of years, because we knew that we weren't going to we knew we were going to make money in the long run, but we we weren't counting on making money in the first 2-3 years. So we had enough savings to set us up that way. But again, we were advised against this theme, but we had to believe that if we focus on the long-term compounding of our clients' assets, and we have this mindset of business owners, and we acquire a bunch of businesses in the portfolio that could compound for us in the long run over the next 5+ years, we would deliver the results. And if the results are delivered, we would get paid. So it's basically kind of running the lean operation, living off our assets. I actually, excuse me, I had to actually move. I used to live in San Francisco when I had my job with big banks, and I was earning pretty good money, getting the bonuses, and I could afford the San Francisco cost of living. I actually had to make a decision to move to Sacramento, which is a suburb. I mean, it's not a suburb, but it's about 2 hours away, and the cost of living pretty much is half or even less than half over there. So I had to reduce my expenses very significantly, maybe by more than half, in order to get through the first few years. And also helps you to be much more disciplined in your own finances as well as the funds.
You also made another decision to partner with your partner, Joe Maas. Why did you decide to see this guy as your wife or girlfriend?
Oh, well, I wouldn't put it in those terms. I don't think of him as my wife or a girlfriend. But
no, I haven't said this, but it's the time you spent with him is a lot, I think.
Yeah, we did. So we met back when we were studying for the CFA exams, and we actually got to be. There's this boot camp up in Canada, which is right before the CFA exams, that goes for about a week. So you live in the dorms and you eat dorm food, and you go to class for 8 hours a day, and then you take 2 mock exams. So we actually got to be roommates in that boot camp, and we for level 1 and level 2. So we kind of kept in touch, and throughout the years, but he lived in Seattle, I lived in San Francisco. Eventually, back in 2014, we kind of accidentally met up in this one training for software we were doing for financial software, and it was up in Seattle, and we kind of met up and started talking about the vision of what I wanted to build over the next 20 years, let's say, and he kind of was thinking along the same lines. And what was very good about our combination is that our skill set is very complementary. I'm very much of a guy that likes to very analytical. I do all this really in-depth research. I like to spend most of my days reading and studying companies and thinking about companies and industries, and just reading annual reports and books. And Joe he's a little bit older than me, and he had much more savvy as an entrepreneur, because he started a couple businesses, financial businesses of his own. So he was very knowledgeable in terms of how to set things up, all the right people that we need to bring in, and he was much more skillful in the business development part of this, which you really need. And that's you never want your partner to be exactly like you are. You want your partner to complement your skills that you may lack or you're not as good at. So I found that in Joe, and he found that in me.
Is there also any downside of having a partner? It's a bit mean to ask this question, the situation he isn't here, but let's try it.
Downside of having a partner. Well, there could be. However, we were fortunate, I would say, that we haven't had much of a downside, because we are just very good. at operating from, I started off doing it from California. He was in Seattle. I moved up to Seattle for a couple of years so we can operate from the same office, but we're also very good from working from different offices in different locations. And we're very kind of understanding of each other's processes and kind of personality and mindsets. So Joe knows that I'm an independent thinker, and I like to spend most of my days, the way I said, like the reading and thinking about things, and tend to structure a portfolio in a very focused way. And I try to develop really solid, strong convictions of companies that we put in our portfolio. And of course, we discuss them together, but he asks really good questions, but he gives me sort of the freedom to play my game and to be my best, and I give him the freedom to do what he does best. And I thought, again, it's rare to find a partner that complements you so well, but I think we've been very fortunate from the past 6 years of running this thing together.
Like, if you're setting up your portfolio, you also gave this analogy of a team you have with 10 or 15 players. How do you make consensus how to nominate for your portfolio, and are there any, or how do you go about negotiating conflicts between you if you say about position sizing, or should this stock or player be added to our team? Do you have such things, or how do you go about this?
Sure. We pretty much, I can't think of that we actually had conflicts over this because, again, Joe is very good at letting me play my game. He knows my strength. He knows what I do best. And basically, and the main thing is we're in agreement on our pretty much 100% aligned on how we want to manage our money and the investment philosophy and the investment process. That we've honed it for many years before starting the fund, and we worked on it quite a bit in the first 2-3 years to make sure that we're on the same page. This philosophy of the 10 players on the team, or getting all the best all-stars in our team, is we're pretty much 100% aligned on. And Joe, we both do this, but I spend majority of my time on this as I try to find the most extraordinary opportunities, the most extraordinary companies to put on our list that we would like to own. And from time to time, we get an opportunity to own them. And as I've described in one of my previous letters, I think it was back a couple of years, that if we have this 10-player all-star team with 10 positions on average in the portfolio, and they're all incredible companies with very wide moats and incredible management teams and just a long runway for growth and reinvestment opportunities, it's pretty hard to compete with them. So any new player that comes in has to compete with the existing 8 or 10 companies that we have in our portfolio and that we know incredibly well. And that's it's a very high bar to get over. So these companies need to do either significantly better, or need to have much better management team, much more opportunities for growth and reinvestment, or something special about them that would, if one comes in, basically we have to take one out, and that's not very easy thing to do if you've been following the company, for example, for 3 or 4 years and you know it well and you are very well convicted in it. It's not easy to kick it out, take your capital gains, and put a new star on the team. So it's usually a gradual process. And if we do decide to do it, the player comes in as a small weight. So in one of my letters, I'm a hockey player since I grew up in Moscow. So I use a hockey analogy where this player gets very little ice time, and as we get more and more confidence in this player's game and how he complements the overall team and the overall game of the team, then the player gets increased ice time, which means increased portfolio weighting, more and more of our capital. And eventually, if that player has potential to be an all-star in the team, he makes it up to be a core position in the portfolio.
What is the performance hurdle you give the player before you let him on the ice?
So from day one, we wanted to compound our clients' capital. That's our kind of long-term goal, is to compound our clients' capital at double-digit returns over the long run. So over the long run, meaning more than 5, 10, and more years. So any player that comes in on the team has to be able to compound at that rate over a long period of time. So we place a big importance in that on the internal compounding of the company. So there's on internal compounding of the company. So the company has to be able to grow its revenues and earnings over a long period of time at least double-digit returns. And then the second part of this kind of compounding engine is also the price that we pay for the company. So obviously we try to pay a fair price. We're not trying to go after cheap valuations, but we just try to simply not pay too much. And if we do pay too much, that can work against that long-term compounding over the long run. So that definitely plays a factor. But again, our long-term goal is that double-digit compounding over the long period of time.
How do you make sure that too much isn't too much? Like we're coming from this Graham world or this cheap world as investors, being nurtured in this with this idea. But if you think about Google or Facebook or other FANG stocks, they always didn't look that cheap.
Sure. No, it's actually a great question, and it's something that I've evolved pretty tremendously in how I think about that since I started the fund, because I also come from the world of Buffett and Graham and value investing, and that's how I actually got interested in this business, and that's who I learned from. So again, in the 20th century, in the old century, that paying a cheap price for certain assets was basically paying like 40 cents or 50 cents on the dollar is basically the way you made your returns. However, I've evolved that thinking quite a bit and over the years, and we no longer we realize that valuation of companies is not our stronghold, and probably it's nobody's stronghold, especially with the type of, in the 21st century, with the kind of technological and platform companies that we have going on right now, and the rate of change that's going on. I don't think it's anybody's stronghold to actually assign a value to a certain technology company. You would not know what Amazon was worth in 2010 or Netflix was worth in 2011. But you could value, for example, maybe an oil company or some asset-based company back in the day is significantly better. So valuation is not our stronghold, and our focus actually, and let me actually come back to that. If you focus first on the valuations, what I found myself is I was tied to this difficult situations or subpar companies that were very difficult to understand. And I basically, when I focused on the valuations first, I got involved in these difficult situations that didn't really play out well over the long run. So I shifted my focus towards basically extraordinary businesses, and that's where I spent probably 95% of my time on. And the theory behind that is, if you find extraordinary businesses, which there are very few actually, out of thousands and hundreds of thousands of public companies out there, and they're managed by super smart, shareholder-friendly management with a vision and passion. These things tend to compound at very high rates of return over the long run. And if you're a long-term holder, you're likely to do incredibly well with these companies. For example, it was pretty much a great price to pay for Amazon at any of the years. If you look at the past 15, 20 years, Amazon, there was never a bad time to buy Amazon. However, we just try not to pay too much. So for example, when the valuations get overly exuberant, meaning they discount something completely unrealistic into the future, this is the kind of situations that we try to stay away from. But when we do find a business that we really would like to own, a fair price is good enough for us, and even paying a little bit of a premium is good enough for us, because these kind of quality companies almost never come at a discount.
I brought a quote from one of your letters for this point, and maybe if you can see it, you can read it out. It's still loading at the moment, but maybe I can also read it out. Do you want to go ahead, or should I? Because it's your words.
Sure. One of the biggest revelations for us that year was, in the past, our thinking was heavily influenced by Warren Buffett and his 20th century success of finding businesses that are highly predictable and do not change very much, observing the rapid technological investments and the emergence of the platform companies in the 21st century that have had tremendous influence on our lives and are disrupting almost every single industry out there, had pushed us to evolve our value investment approach to the 21st century. We realized over and over that, in fact, change is the driving force for creative destruction and value creation. Thus, we needed to spend more and more time understanding change and the people behind it, rather than trying to find businesses that are unlikely to change over the next 5 to 10 years.
I think the most important word from this quote is change. So how do you put change, or the valuation of change, or the thinking about change in your investing framework? And what instruments do you have to measure change and to predict it right in a certain way, or directionally right in a certain way? A lot of questions, so it's just give you the chance to answer.
So change is a given. If you're not changing, if the company is not evolving, it's not making any progress, it's not innovating, if it's not thinking at least 10 to 20 years ahead, it's not going to survive in today's pace of change. And this is exactly why I wrote this in the letter. And there was a huge departure from what Warren Buffett honed his success on in the past century, where he was looking for businesses that, like Wrigley chewing gum or Coca-Cola, that don't change very much. And it was very predictable what this business was going to do over the next 10 years, or the kind of service or a product is going to sell over the next 10 years. However, in today's environment, from what you see in the platform companies, a company that you saw starting to sell books is now in the cloud. A company that you first start seeing, mailing discs in compact discs over mail, competing with Blockbuster, is now the biggest player in Hollywood and has the biggest budget in Hollywood. So these kind of things are very difficult to predict over the long run, but you can kind of have a little bit of a sense of the mission and the vision of the founder of the company and the culture where this train is basically going. And that's why I try to spend a lot of my time on, is basically understanding the history. So in my research, I typically try to go very deep, and I try to understand the founding history of the company. I try to understand why the founder did what he did, what problems he was trying to solve from the beginning, and what his vision was, and what the typical foundational principles that he founded the company based upon, and what his vision really is. And that vision typically tends to evolve from all the founders as they grow the company and they start to see new opportunities. They start to go into different industries and different product lines and different service lines. And that is extremely difficult to predict as you're looking out 10 years. However, what's easier to look at is that foundational kind of underworkings of the company, and that's basically starts with the founder and the cultural foundation and the cultural values of the company. And that takes, actually, it's very intangible. So as when I was working for these large Wall Street firms, and even when I started the fund, I tend to focus a lot on numbers and spreadsheets and the financial statements, and trying to do the valuations and come up with price targets. And that's typically what everybody does in the industry. However, I've learned that that's completely unimportant if you're trying to make long run bets. What is important is other intangible things, and those intangible things you can't read from a spreadsheet. Obviously, spreadsheets and numbers are helpful in understanding whether the managers of the company are delivering upon the vision and what they promised. However, the intangibles come from really studying the company over the long run, studying, listening to a lot of interviews with management, listening to a lot of earning calls, trying to read between the lines to see what they said 5 years ago and what they're currently executing upon. It's kind of conviction is something that's developed over the years, and it's kind of a little bit like love and trust that it's earned over the years, and either it grows stronger as the longer you own the company, or it dissipates. So it's very intangible. It's very hard to place in any kind of number.
So what factors have strengthened your conviction and what factors have lessened your conviction? Maybe you can also, we decided to think about 2 examples, PRA group and Spotify, or you can answer it based on the examples, or we can go into general factors if you have general factors in mind.
Hey, Tillman here. I'm sure you're curious about the answer to this question, but this answer is exclusive to the members of my community, Good Investing Plus. Good Investing Plus is a place where we help each other to get better as investors day by day. If you are an ambitious, long-term oriented investor that likes to share, please apply for Good Investing Plus. Just go to good-investing.net/plus. You can also find this link in the show notes. I'm waiting for your application. And without further ado, let's go back to the conversation.
So maybe if you like this honest answers, I would love to have an honest answer on this question. What were your mistakes in the last years?
So there's definitely been plenty. There's lots of mistakes that I've made. And if I tend to think of those, my biggest mistakes, if I focus on my biggest mistakes, they were actually mistakes of omission, meaning that we passed on a number of opportunities that were right in front of us, and that completely fit all our investment criteria. We could understand the business. It fit all our three-part kind of compounding machine engine, but we didn't pull the trigger. We kind of sat on our asses and did not pull the trigger, and that actually cost our shareholder base quite significant money, because so mistakes of omission is pretty much number one mistake that I would say that I've learned from, and that I've made over the past 6 years of running the fund. Another huge mistake is selling too early. So I have also found from experience that one of the big lessons that I learned is that if you own a great, extraordinary business, the time to sell it is almost never. And, we actually did that mistake with Chipotle is one of the companies that we've owned, and we were lucky to pick it up at a very nice price when it was experiencing its kind of the health issues that were going on in their kitchens back in 2016, 2017, and all the scandals that were going on. We purchased them at a very attractive price, and then we actually sold it only 6 months later when we made 80% profit. We made the profit of 80% in 6 months, and we decided it was a great time. We decided the stock was overvalued, and we decided to take our profits, only to see it become another faux-bagger since then. As the management executed, and the company continued to be great. So this Wall Street term, you never go broke taking a profit, is complete BS in my mind. It's actually, you couldn't be further from the truth. Selling Amazon or selling Netflix was always a mistake if you were lucky enough to own those. So those are, I think, my two biggest mistakes that I've really learned from.
So what did you change in your process looking at these mistakes, and what do you now want to make differently?
So I think my process started significantly changing in 2017. That's where I made this really abrupt shift from, like I read in that quote from one of my letters, from the Graham and Buffett approach, value investment approach of 20th century, and looking for undervalued companies, to actually studying greatness, and that completely shifted not only my mindset but how I allocate my time. So if you're in this day and age, if you're focused on cheap companies or companies that are statistically cheap, you're basically spending a lot of your time on companies that have problems. They're not great, and that takes away from all your time that you can be spending on studying great businesses, studying winners that actually deliver year after year, and the management team that are winners. So that back in 2017, I started, instead of kind of shining these businesses because they were labeled as technology, and their pace of change was too fast, or they were unpredictable kind of businesses as labeled by the typical value investors, I actually spent a lot of time studying them, and I read a lot of books, and I actually went back. One of the first things that I did was actually went back and read Jeff Bezos' letters all the way back to 1997 from the first letter, which for some reason I've never done, and that kind of hit a light bulb switched in my head because the guy pretty much laid it all out there, even in the early years, what he's going to do, his vision, how he's going to do it, the way he thinks about it. It was all out there. They're kind of the early signs. Obviously, it's hindsight is 2020, but there's a lot you can learn by studying these kind of companies and studying greatness, and you can learn a lot of ingredients there in there. Even in the early days, they're required for a company to be extremely successful and to compete against all those much bigger companies with much bigger resources, for example, like Spotify did, and that's outlined very well in the book. So that was a huge kind of shift in my kind of thinking, in my mindset and approach, and how I spend my time.
In the way you describe companies, you still mentioned the word mode. How does this fit with your framework of change? And how do you think mode and the ability to change in a company?
So mode is something that's been pretty much, it's been termed by obviously by Warren Buffett, but it's been pretty much used very widely by pretty much everyone. But it can mean very different things. The moats that were typical in the older century, because in the 20th century, because before we had all these internet and platform companies developing like they are today, came from brands, came from possession of some physical property, came from basically the moats were very different from how I judge moats today. The moats today come, in my opinion, from me studying companies for quite a long period of time, come from the mindset and the culture, like I've said, that the founder develops early on, and the values and the principles that he instills in the company early on, because from day one, it's a given this company is going to look very different in the year from now and 3 years from now, and especially it's going to look very different from 5 years from now, and it's very unpredictable where this business is going to go, what industries and verticals it's going to participate in. However, that's one thing that kind of stays constant, what I found. For example, one company that gets a lot of kind of negative media press for obvious reasons, and it gets a lot of backlash is Facebook and Mark Zuckerberg for a lot of ways he manages the company. But if you really study what he has done and how he put together Facebook and his visions that he had for the company from the early days as a founder have not changed very much. He's a very mission-oriented guy that is willing to stay the course no matter what kind of hurdles come his way, or what kind of competition or what kind of scrutiny comes his ways. And he is pretty much unwilling to stray away from his mission. So I think his biggest advantage is his focus, and everything he does with his day, every piece of energy that he expends is focused on that mission. That never changes. Whether he was trying to build Facebook out of his dorm room in Harvard, and now that he's trying to develop metaverse, what he was focused on and his vision and the way he runs his company never changes. And so those are kind of the ingredients, kind of intangible ingredients that I would say that I try to look for. And those are not easy, and these things take a lot of time. It's not something that you can read in the magazine or from the article or from studying, some numbers on the Bloomberg terminal.
Rowan Street is one of these investors who's looking for high quality businesses. What is your characteristic of a high quality business?
So high quality business, again, it goes back to our focus on this compounding machine and three main components that go into that compounding machine, and that's the moat of the business and the management and the reinvestment opportunities. So it has to have all three. I actually borrowed this concept. I didn't invent it. I borrowed this concept from the Acre funds, and I must give them credit that it's incredible manager that I followed for a long period of time. It's been a huge inspiration for me, and it was a three-legged stool that he named it. But the concept was pretty much the same. Is the company has to exude all the ingredients for it not only to not necessarily have a wide moat today, but to develop that moat over the long run. It has to have some certain ingredients that would make it very difficult for competitors in the future to come in and replicate their business. And it has to have, obviously, we look for very attractive growth rates, a very long runway for that growth, huge markets, and the management teams that are, like I said, visionary. They're focused on their mission. They're able to execute year in, year out, regardless, and they're able to be majority shareholders on the firm and stay invested in the firm and be very shareholder oriented. And again, from the opportunities that they have to have a number of reinvestment opportunities, and not only to have them, but to actually be able to execute on those in a very kind of exceptional manner. So that's why I would consider very high quality companies, and those are simple kind of ingredients, but they're not very easy to attain. If we look through thousands of publicly traded companies out there, even if we take United States market, for example, we maybe will find less than 100 companies, or even less than that would fit that criteria. So there's not very many companies you're working. The universe is very small to begin with.
In your letters, you also mentioned the term exceptional opportunities for doing an investment. What are such exceptional opportunities for underwriting an investment?
So exceptional opportunities meaning from the company's perspective, or from our perspective as portfolio managers?
To do an investment, you're looking for this. You said you're looking for exceptional opportunities. What are these? Like,
so from my perspective. Yeah. So these, like I said, continue on our previous question. Once we identify these kind of very exceptional companies, which aren't very many of them, it's a pretty small universe. We try not to pay too much for them, obviously, and we still try to be mindful of what we pay. We're not, buy at any price kind of investor still. But again, the valuation part and the price part comes after the quality of the business, not before. However, and from time to time, the market, gives us average. If you look at the average stock that's trading even in S&P, if you high to low ratio is pretty much maybe 70 or 80%. So average, most people are taught that the markets are very efficient. However, it's in the short run, the truth is very far away from that. Average stock fluctuates maybe 80 or even more so in the recent years, 80% or 100% or more. So from time to time, a company may hit a speed bump, or it can start doing something that majority of the market players don't understand yet, or are not willing to look beyond the next several quarters, not willing to focus on the next 5-10 years. And from that, come exceptional opportunities to be able to acquire these kind of companies at least fair prices, because most of the time these companies are trading either nowadays at abnormal, crazy valuations or huge premiums to where we would like to pay for them initially. So if these exceptional opportunities come, we try to kind of be we're very patient and waiting for those, but we try to be very aggressive and execute kind of fast as as of the essence for us.
How many of such opportunities do you find a year?
So we actually, contrary to kind of what I find most on Wall Street, we actually don't do a whole lot in terms of activity. We spend most of our time on kind of reading and thinking, and not doing so much. And from our perspective, if we find only 1 to 2 opportunities per year, that's a successful year. Sometimes we may find 0, but if you're running on average a 10-player team, and that's an exceptional team, finding 1 to 2 opportunities that could potentially get into that portfolio and replace some of those core holdings is very difficult. So if I find 1 to 2, I would think it's a successful year. And we tend to our turnover tends to be pretty low. I would say below 20%. It varies from obviously year to year what happens in the marketplace.
Maybe let's go back to the beginning and the reference to Wall Street you also make. Maybe let's imagine after this interview, someone from Wall Street decides to call you and wants you back to work in a firm setup and says, you can name me the amount, I'm happy to give it to you to come back. Where would you say I would consider it, or where would you say I do it?
I would definitely not consider that, because for no money, it's not even consideration, because why would I give up something that I've built on my own and I love to do every day? And I pretty much, like Warren Buffett coins it, tap dance to work every day, where I really enjoy doing what I'm doing. I have a great partner, great LPs, and I'm doing exactly what I've always dreamed of doing since college, pretty much, and doing it in my own way, on my own terms, running the firms in my own principles. Why would I ever trade that for doing it for somebody else for more money and giving up on the principles that are so dear to me?
Maybe let's go back to the idea of change and also think about how you have changed coming from Wall Street. What is still in you from this time of being at Wall Street? If you want to name a percentage or some things you still do like you did it like 10 years ago, for instance?
That's an interesting question. I would say very little now, very, very little. The good the knowledge that I've learned from Wall Street is I got to see who my competitors are and how the money is being managed and what the typical mindset out there. Because sometimes when I acquire companies, I try to reason with myself, why is this opportunity selling at where it's selling at? What am I doing wrong? And being able to understand the flip side, what Wall Street is thinking, how they run money and how they approach things, and the whole compensation system that the Wall Street has got is very helpful. And I think that's the only pretty much helpful thing to me in running the fund. In my early days, when I first started the fund in 2015, I would say quite a big portion of me was carried over from my Wall Street days, because in my early days, I did focus quite a bit on the macro perspective, and I was still reading Wall Street journals and the Barons, and again, when you start a fund, you're just trying to survive in your early days, and the worst thing that can happen to you is you start a fund and the market goes down 30-40%, and you lose all your clients. So we were very careful in the early days investing the cash and developing the processes to develop that initial track record. And that came with paying a lot of attention. Instead of focusing on the great companies, we were paying a lot of attention to the macro economics, which was a huge distraction from our returns in the early days. And again, that came from a lot of BS that I have acquired working in my previous life for big money management firms. However, I've learned from that, and that completely dissipated. And I would say today there's very little left. And one huge difference also I would like to add is how I spend my time, where typically on Wall Street as a portfolio manager, I would spend more than 90%, sometimes even 95% of my time in various meetings, meeting with clients, meeting with prospects, company meetings, offices, which is completely structured that way, because if your goal is asset gathering. However, I've always wanted to flip it on upside down and spend 95% of my time on actually researching and managing the client's money, and maybe 5% on doing these other things that I need to do in order to run and grow my firm. So I think that's one of the things that pleases me the most is how I spend my time nowadays versus where I spent my time before.
Thank you very much for your insights. For the end of our interview, I want to give you the chance to add something we haven't discussed. Is there anything you find that's interesting for the viewer you want to add?
I think we covered a lot of topics. It's a little, it's a little difficult to think of something else to add without starting a huge other topic that we may go into. So I would say we've covered things pretty well for our first interview.
Great. Maybe then if you have one or two ideas you want to drop, maybe it might be the catch for the next interview you have as a chance, but you don't have to.
At this point, I would say that's good. As I would leave it as is.
Thank you very much for your time, and thank you very much to the audience for listening to this interview. It was a great pleasure. And
yeah, thanks very much, Tillman. Thanks very much for the time.
Bye-bye to you all.
Bye-bye.
As in every video, also here is the disclaimer. You can find the link to the disclaimer below in the show notes. The disclaimer says, always do your own work. What we're doing here is no recommendation and no advice. So please always do your own work. Thank you very much.